Good evening and welcome to our session today. Today we'll be covering lump sum benefits. Our session for today is going to be more interactive than just me speaking all the time. I would like to start off by just getting understanding of where everybody is and seeing how much you guys know or how much you guys understand from what you've already prepared, because this is just to help you see if there are gaps in your knowledge and where we can help each other in with regards to the gaps. Ne? So to start off, I've prepared some questions. These are multiple choice questions and also true and false questions that I would like you guys to answer. So the first question that I've prepared for us is with relation to the severance benefits. So the question is, which of the following would not meet the condition of a severance benefit lump sum? So I've prepared four scenarios, and you guys need to tell me which one of these would not meet the conditions of a severance benefit lump sum. So the first one is Annie, who's 33 years old, has been diagnosed with a medical condition. Her employer was unable to find her a more suitable role and has rather opted to terminate her employment. Her employer paid her a lump sum of 300,000 Rand as compensation for the termination of employment. That's option A. Option B, ABC Candy has offered Michelle a lump sum payment of 650,000 because his position was found to be redundant in the new organizational structure. Option C, Rory, who's 58 years old, decided that she would like to spend more time with her family and thus requested that she retires. Her employer paid her a lump sum of 850,000 as a severance payment. Excuse me. Option D, at the age of 54, Luke decided that he would be resigning from his employment. His employer paid him an amount of 350,000 Rand as a severance package. So which one of the four would not meet the condition of a severance benefit? And why do you say that?
I think that the answer is C.
Okay.
I think it is C because D.
I think none of these would apply.
Tell me why.
Even though there's one case where it's above the age of 55, right? But it's mentioned in the textbook that they have to be retrenched, injury, or an accident, or some sort of like medical reasons for them to qualify for the severance benefit, and none of these apply to what's on the textbook.
Okay. All right.
I think the correct option is D, because even though in A, Annie is under the age of 55, she's been terminated due to a medical reason. And then B, that's okay because her job was found to be redundant. C is okay because he's above the age of, she's above the age of retirement. So I think it's D.
Correct. Thank you. That is the correct answer. D is the correct answer. So remember, our severance benefit lump sum conditions, there are three of them. The first one is that the person is older than 55. The second is they're leaving because of either an illness, an injury. So if they had an accident or illness or an injury, so that would be their reasoning. So Annie would then be applicable in that situation. Rory would have been applicable because she's over the age of 55. And then Michelle is because he is, his position has become redundant. So he would then meet the third condition, that would be because you're being retrenched or because there is no place for you within the organization. So the correct answer was D, because Luke is actually younger than 55. So it goes to show that we need to check the way that we read. We make sure that we read correctly, because it's a simple thing. It's a simple way of losing out on our marks, because now we see 50 and then we forget that there's actually a 55 that should be there. So because of the fact that Luke is younger than 55, he would not have made the conditions of a severance benefit lump sum. So then he would be taxed using the normal gross income rules and also the normal tax table. Excuse me. Does that make sense? Are we all together? Thumbs up. The second one, the question is, when determining the taxable retirement benefit, the following, which of the following will not be allowed as a deduction? Susan and Michelle finalized their divorce during the 2021 year of assessment. Susan was requested that the total maintenance be paid out of the minimum individual reserve of Michael, it's a retirement fund, in the 2023 year of assessment, since Michael had failed to make the maintenance payments that were awarded to him. Then B, Sue and Ronnie finalized their divorce during 2023 year of assessment. According to the divorce order, Ronnie was entitled to 500,000 out of the minimum individual reserve of Sue's retirement fund. C, Susie resigned from ABC Consulting. She requested that 800,000 Rand from ABC Provident Fund should be transferred to her new Provident Fund. And then D, on the date of his resignation, Teddy had a pension fund contribution, contributions of 24,000 Rand, which were not allowed as deductions in terms of Section 11F, Cap F. So which of the four would not be applicable or would not be allowed as a deduction against the taxable retirement benefit lump sum?
I think number C, because Sue resigned and then she requested that the Provident Fund should be transferred to a new Provident Fund. So that was not a withdrawal, it was just a transfer due to the moving to the new job.
Okay.
Yes.
That's a good attempt.
I would say D, because this deduction was not allowed.
Okay. So when we are calculating the taxable retirement benefit or the lump sum benefit, we are allowed certain deductions, and part of those deductions include our contributions that we couldn't have claimed, that were not allowed as part of our Section 11 Cap F deductions. So D would not have been the correct answer in this situation, because Teddy would then be entitled to claim those deductions against the lump sum benefit that he receives when he resigns, or when he retires rather. And then the other attempt, I think you said C, right? Okay, so if now we are moving from one a retirement to, if we are now moving from one fund to the next, we shouldn't be taxed on those amounts. So actually that would have been so the correct answer, sorry, would have been A. Let's start from there. Let's start with the correct answer. Would have been A, because now this was not a divorce order, but it was instead a maintenance payment that Susan went and requested from the court. So when we are making the deductions, you are allowed for you're allowed deductions against divorce order. You're allowed the transfer from one provident to another, or not one provident or pension fund to another, and then you're also allowed the deductions that you couldn't have claimed during the time that you were employed. So those are the three that would have been allowed as deductions. So the one that wouldn't have been allowed would have only been the maintenance payments that arose because of the divorce settlement.
I'm sorry, I didn't quite get your last explanation on.
Okay.
You mentioned that we allow deductions from transfers.
Yes.
And the question is asking, when determining the taxable retirement benefit, the following will not be allowed as a deduction.
Yes. So
So
the
I'm
one
not
that would, okay, sorry.
quite getting why we have to deduct the transfer, and yet she's not yet utilizing that transfer as yet, since she's moving to a new job. And then I also didn't quite get the issue of divorce and maintenance.
Okay. So with regards to the divorce and maintenance, there's two types, né? There's a divorce order where in the agreement that you had, according to what the court gave you, you would then be allowed to take, let's say, 50% of your ex-spouse's retirement fund from the reserve that they have available. And then there is also a maintenance order where you are supposed to be paying, or the ex-spouse is supposed to pay a maintenance every month. They must pay for your food or the kids or whatever reasons. So if now the person gets your pension fund because of a maintenance order, that would not be included as part of the things that are allowed as a deduction. But if now it was because of the divorce order or the divorce agreement, the decree that you had when you get divorced, then that would be allowed as a deduction. But if it was just because of maintenance, then it wouldn't be allowed as a deduction, because that only arose because of the fact that you need to maintain that person. But if it was according to the agreement that the court signed, that, okay, this is the divorce order, you can get 50% of that person's retirement fund, then that would then be allowed as a deduction. So there's two types. So one is a maintenance order and the other one is a divorce order. Okay.
Okay.
That one makes sense?
Yes, thank you.
Okay, let's go to the transfers between the funds. So because of the fact that you're not yet, what's the word? In this case, let's say I am resigning today from my employer, right? And they give me R1 million, for instance, because of my contributions to my provident fund. I've decided, okay, I'm only going to take 200,000 Rand now. The 800,000, I request that they put it in my new employer's provident fund. I'm not utilizing that money as yet, that 800,000. I'm not utilizing it. So I'm not actually going to get that money. It doesn't come to me. It goes to the Provident Fund. So I don't have access to that money. So it's not fair for them to now decide that they want to tax me at this moment, because when I do retire later on, then they can actually tax me on that amount of money, because then I will get it in the bank. But now, because it's not going into my bank account, only the 200,000 is going in my bank account, then I'll be taxed on that 200,000, but the 800,000, it will sit there until such a time then I retire for good. Then they will tax me on that 800,000.
All right.
Okay. Are you satisfied with the answer?
So why are we not taking it as the answer that it will not be allowed as a deduction, since we are not yet taxing it? Are we saying because we are not utilizing it first, it's not even going to be part of the taxable income? Is that why
Yes.
it's not going to be allowed as a deduction?
So it is going to be allowed as a deduction.
Okay.
You
All
will
right.
listen. So what you will actually be allowed to deduct is that transfer. You will be able to deduct that transfer against. So let's go back to that 1 million example. I'm only going to get the 200,000 in my pocket. So the 800,000 needs to be reduced from the million. I cannot be taxed on the full million. So they must first deduct the 800,000 and then only tax me on the 200,000.
All right, thank you.
Okay, awesome. Thank you. Okay, so
Hi, sorry.
yes.
I just have one more question. So, on maintenance, is no form of maintenance deductible from your taxable income?
No.
Okay, all
not
right.
now. There was a time when it was allowed, but not anymore. That was like long time passed very far back. So now it's not deductible anymore.
Okay, so that's all included in your taxable income.
Yes.
Okay, perfect. Thank you.
All right. Okay. Happiness. Thank you, guys. So these are just the answers that we have already discussed. Okay. So now we're going to do a true and false kind of questions, and then we'll take it from there. So the first true or false statement is the severance benefits and withdrawal lump sum benefits are taxed according to the same tax table. Is that true or false? And why? There's only two options, so one must be right.
I think it's false.
That's correct. Why do you say it's false?
Because it's taxed using the same table as the lump sum received on retirement or death or retrenchment.
Yes, that's correct. See, that one was a nice one. Thank you. So as I didn't get your name, who was that?
Cynthia.
Gina.
Oh, Gina, sorry.
Gina, okay. Thank you, Gina. As Gina has mentioned, the tax table that we will use is the one that is for retirement, death, or retrenchment. The withdrawal lump sum is there by itself, so we don't use that tax table for the severance benefits, okay? So it's actually beneficial that they use the retirement tax table because it's more favorable for the taxpayer, whereas the withdrawal lump sum tables are actually a bit higher than the one for the retirement. So it's beneficial for you to actually use that tax table. Okay, so then the second one, an individual with an assessed loss can reduce the taxable lump sum benefits. Is that true or false?
I think it's false.
Yes, that's correct. So when we are calculating our taxable lump sum benefits, the only things that we are allowed to deduct against that taxable lump sum is, again, the divorce orders, the transfers, our the amounts that we're not allowed as deductions as part of our Section 11 Cap F. So our assessed losses or our tax credits will not be allowed as a deduction against our taxable lump sum benefits. So when we are doing our calculation, normally we will get an integrated question. So you need to always make sure that when you're calculating your taxable lump sum benefits, you calculate it as a separate amount and not with our normal tax on our normal income that we receive as part of our taxable income. Okay. So the third one, a lump sum benefits are taxed on a cumulative basis instead of a progressive tax basis. True or false?
It's true.
Yes, that's correct. So what does that actually mean? So let's say now while I'm working, I resigned, and then I got a payment when I resigned, let's say of 500,000 Rand. Then in 10 years' time, then I go on retirement and I now receive my retirement lump sum amount. Then that amount that I had been taxed on, that 500,000, must still also be taken into consideration when they're calculating the lump sum, the taxable amount on that lump sum. So we won't just say, oh, okay, you got 500,000 when you resigned 5 years ago. That's nice. We will take it into consideration now when I go on retirement, and we will calculate it as if I am getting that 500,000 now as well. Okay. So then the fourth one, an individual can claim a notional tax for any lump sum previously taxed as a credit or a deduction.
That's true.
Yes. So when we're calculating our tax on the lump sum, we will then, going back to that example of when I was 10 years ago, I got 500,000 when I resigned, and 10 years from now, I go in retirement. When we are calculating the tax payable on the full, let's say 101 million plus the 500,000, I will then be allowed to go and calculate a notional tax on the 500,000 using the retirement tax tables. It will not be the same amount as the amount that I actually paid when I got the 500,000. It will be the amount that is calculated using the new table now. So it will be less. It won't be the same amount that you paid when you were withdrawing, because with the withdrawal, it's always more than with the retirement tax tables. Okay. Awesome stuff. So then the last one, an employee of the municipality started working on 1 January 1990. Will the employee be taxed on the full retirement fund lump sum on retirement date 15 December 2024? True or false? Oh.
It's false.
That's correct. So employees of the government were very fortunate back in the day. They were allowed to not be taxed on the lump sums that they were getting until the 1st of March 1998, right? So from the 1st of March 1998, everything that they got from there, then that will be taxed. So before that, you would not have been taxed on it. So we would use the formula that is A is equals to B over C times D, and B being the number of years that you were in service or that you were contributing to the government pension from the 1st of March 1998 until the day that you retire. And then, so in this case, it would have been from the 1st of March 1998 until the 15th of December 2024. And then we would count the number of full years that the person was in service, and that amount would then be the B. And then the C would be the total number of years that you were working. So from the 1st of January 1990 until, the 15th of December 2024, then that would then be our C. And then multiplied by D, D being the amount of the retirement lump sum that you actually got from your employer. Okay. Happiness, does that make sense? So this is just like a quick summary of the things that we covered during, or it's the things that were covered in the section of lump sum benefits. So what we actually need to always remember when we are doing the calculations for the retirement or the lump sum and benefits, right? So that was just like a quick overview of the chapter. So I always believe that tax is something that we practice. It's not just head knowledge. So I have a question that we will go through, and we will work through it. And then whatever questions come about while we are working through the question, then you guys can ask. Is that okay? So in our example, we are required to calculate Mike's taxable tax liability for the year of assessment ended 29 February 2024. Okay. So Mike was employed by the South African Post Office, which will be called SAPO from here on out. He started working at SAPO on the 1st of March 1992, straight out of university, and has worked there until the 31st of January 2024, when he turned 60. So we know that SAPO is also part of our government companies, government entities. So he would then be part of the people who contributed to the GEPF, right, or the Government Pension Fund. So we will need to remember our formula A is equals to B over C multiplied by D. That will then be applicable when we have to do the calculation for the retirement, the tax payable for our retirement lump sum. Okay. So during this year, while he was employed and after he went on retirement, he received a salary of 40,000 Rand per month. And then he got a pension of 15,000 Rand per month after he retired. And then he also got a lump sum from the pension fund of 2.2 million. So it's 2,250,000 Rand. And then he also got a gift from his colleagues of 5,000 Rand. And he also got a long service award from his employer of 10,000 Rand. Okay. So that is part of the information that we need to remember when we're doing our calculation. Let's just discuss the income and the treatment of the income. Okay. First of all, our salary, that will be our normal gross income inclusion, right? So he would then take the 40,000 because he worked from the 1st of March 2023 until the 31st of January 2024. That is 11 months of our year of assessment. So he would take the 40,000 Rand and we would multiply that by 11 months, because that's the amount of months that he worked during the financial year, the year of assessment. Then he had a pension of 15,000 that we would only multiply by 1 month because he retired. His retirement started on the 1st of February, and then the year ended on the 29th of February 2024. Then the lump sum that we get from the pension fund, that we will then tax according to the retirement tax table, right? And then the gift that he receives from the colleagues, what do you guys think? Is that part of our gross income, or is that something that we wouldn't tax at all?
I think we don't tax the gift from the colleagues.
Okay. Why would you say that?
Because it's not a payment for any of my services.
That's correct. So it's not an amount received for services rendered. So that is just a parcela gift. You won't get taxed on that amount of money. Then with the long service award of 10,000 Rand, how would we treat that? What's your guys' take on that?
The long service award will be included in the taxable income, but will be 5,000 will be exempt from it.
Okay. Next person. So the 5,000 would be exempt, and then only 5,000 would then be taxable, right? Awesome. I love that you guys are like remembering your prior knowledge information, so it's good. So whenever you're studying, you never want to forget what you learned previously, because it always comes together. Everything comes together. Okay. And then he had expenses, pension fund contributions until he retired of 3,500 per month. Then he also had a retirement annuity contribution of 34,000 Rand. Then he had medical aid contributions of 12,250 for the whole year. So how would we treat our pension fund contributions until retirement? Can I get your guys' take?
I think we should not include, we should deduct the personal contributions of the retirement for the pension fund because they were deducted from money that has already been taxed. I think we should the contributions, the personal contributions to the retirement funds cannot be taxed because they were already they were taken from income that was already taxed. I don't know if that makes sense.
Okay, I think I understand what you're saying. But remember, now we are calculating his tax liability. So we're going to be taxing, we actually want to determine what's his taxable income for the whole year. We're going to do that for his normal taxable income, as well as the lump sum benefit that he received on retirement. So we'll take the, excuse me. So we'll take our 3,500 per month. We're going to multiply that by 11 months that he actually made contributions for the year or while he was still working. And then that will then be part of our or Section 11F deductions that we will allow for him if they fall under the limits that we have for the year. Okay. Awesome. Okay. And then what do we then do with the retirement annuity fund contribution? Hi.
I firstly I have a question, right?
Yes.
You said 11 months. I want to ask why you didn't say 12 months. I'm kind of like confused by that.
Awesome. No, it's fine. So remember, he worked until the 31st of January 2024. This is when he actually stopped working.
Okay.
Yeah. So our year of assessment runs from the 1st of March 2023 until the 29th of February 2024. Yeah. So in his case, he stopped working before the year ended.
Okay.
So then it runs from the 1st of March, April, May, June, July, August, September, October, November, December, January. Okay. That's 11 months.
Okay, I see it.
Awesome.
About the retirement fund, you're gonna add it along with the, what is it, the pension fund contributions?
That's correct. Yes, that's correct. So that will then make up our contributions that we can then determine, or we'll see if then it will be less than the, excuse me, the limits for the year in terms of Section 11 Cap F. So then when we do our calculation a bit later on, I'll show you now, if now it's going to be less than the 350 or the 27% of our taxable income or remuneration. So we'll see just now when we do the calculation. Okay. Then what do we do with our medical aid contributions? So then with our medical aid contributions, there are no deductions that we are allowed. So we will then be allowed a medical aid tax credit in terms of the Income Tax Act. We will then be allowed to then use, in this case, Mike is alone. So he will have that 364 Rand that he can use per month as part of his tax credits. So we will see that when we are doing our tax credits at the end. Okay. Then additional information. Mike was married to Rebecca, but due to irreconcilable differences, they got divorced on the 1st of July 2020. According to the divorce order, Rebecca was to receive 350,000 of Mike's pension fund. So what do we do with this information?
I'm not sure, but I'm assuming that the 350,000 would be deducted from Mike's pension fund, and wouldn't it be, I don't know, I think it would be taxed in Rebecca's hands. That's what I'm assuming.
Okay, yes, you're correct. Your assumption is correct. I like your assumption. Thank you. So in Mike's case, we will then give it to him as a deduction against the taxable lump sum benefit that he receives. So he will then be allowed to deduct that 350,000 Rand from there. In Rebecca's hands, she would then be able to include that as part of her income, and then she would have had to declare the tax on that 350,000 Rand. Okay. Awesome. So let's look at our solution. We take our salary of 40,000 Rand per month. That would, or did I say 35,000 Rand? No, I said 40,000. Okay. That would then give us an amount of 440,000 Rand for the whole year. Then the pension after retirement is the 15,000 for 1 month, because he only would have received it for February. So only the 15,000 for February would then be included as part of our taxable income. Then the gifts from our colleagues would not be part of our gross income, because it was not for services rendered. So it's not actually deemed to be part of our remuneration. Then the long service award, as we have established, he will then be exempt the 5,000 Rand, and 5,000 Rand would be taxed. So then our taxable income is 460,000 Rand. Then now we must calculate any deductions that he's allowed. In terms of Section 11F, he had a contribution for the retirement annuity of 34,000 Rand. And he also had the pension fund contributions of 3,500 Rand. That multiplied by 11 will give us 38,500 Rand. So the total contributions for the year amounted to 72,500. So now we need to determine if this is above or lower than the limit in terms of Section 11 Cap F. So we know that it's 27.5% of the greater of either the remuneration or the taxable income. So everything that he received was his remuneration. So the taxable income and remuneration in this case would then be the same amount. So it would be 126,500, because that's 27.5% of the 460,000 Rand. And then limited to the lesser of the 350,000 Rand, or 126,500, or 460,000. So we actually going to be limiting it to the actual contribution of 72,500 Rand. So we will give him the full amount as his deduction. Okay. So the 72,500 Rand will be deducted from the 460,000 Rand of the of his taxable income. Then his taxable income for the year would be 387,500 Rand. So this would then be the amount that we're going to use to determine his normal tax as per the normal tax tables. Okay. So then let's look at our taxable portion of the lump sum. So he received an amount of 2,250,000 Rand from the government pension fund. So we now know that we need to first determine how many of the years that he worked was after the 1st of March, 1998. So he started working in 1992. So now we're first going to go 1st of March 1998 all the way down to the 31st of January 2024. So let's then do the math and see how many years will that be. According to my calculation, it actually should have been 25 years. I'll just correct that for you guys before I send the slides. Yes.
Manuel's hand is up.
Hi.
Is it not what when I calculated it, it's 25 years and 11 months. Is it not supposed to be rounded up? Or we just work with the years and ignore the months?
So it shouldn't be rounded up. It should be the full years, the years that he worked fully. So it should actually be 25 years, not 26 years. In this case, I went 24 minus 1998, which is incorrect. So it should be 25 years.
Thank you.
Okay, awesome. Okay, I mean, it would be over 31, not 32, because also again, the full years was 92 until 2024. So the full year would have been 2023. So it would have been 31. So let's just run with it the way it is. I'll correct it and then send it to you guys when we send it to you. So we'll take the 26 over 32 multiplied by the 2,250,000, and then that would give us the 1,828,125 rand. Okay. Does this calculation make sense to everyone? And then now we're going to see, are there any allowable deductions against that amount of the government pension fund lump sum that should be included in his gross income, which is that 1.8 million. So less the allowable deductions would be if there was any portion of the retirement fund contributions that were disallowed, then he would be allowed to claim it. But in this case, Mike did not have any amounts that were disallowed, so that will be 0. The award of the divorce order, the 350,000 rand that they gave to Mike's ex-wife, that will be then deducted from that amount, leaving us with the taxable portion of 1,478,125 rand. Okay.
I'd like to know that how do we know that we have to use the formula ABC, this ABCD, unlike when we use the Y is equals to A over B times C. That one I know, but on this one I'm confused.
Okay, so this one is specifically for those who are part of the public sector. So you would look, if it actually specifies, in this case, they said to us that this person used to work for the South African Post Office. That is part of the public sector. If they say to you, this person works for the municipality or SARS or any of the government institutions, then that person would fall in this. And if they started working before the 1st of March, 1998, but if that person wasn't working before 1st of March 1998 and they weren't an employee of the government, then it would not be applicable to that question. Then you could just move on to just using the normal route. Okay.
Okay, thank you.
All right, awesome. So this is just for government employees. Okay. So then now the calculation of our total tax. Now we take our taxable income that we calculated, the first one, the 387,500. And we go to our tax table and we'll take the 387,500 minus the 370,500 that we get on our tax table multiply that by 31% plus 77,362, which would give us 94,362 Rand, less any our primary rebate. So this person is younger than 65 and younger than 75, so they wouldn't qualify for the secondary or the third rebate as well. Then we know that he made contributions to a medical aid. So medical scheme fees credit would be the 364 Rand multiplied by 12 months, which would give us the 4,368 Rand. Then in any additional qualifying medical expense tax credit, the contributions were the 12,250 less the 3 times of our medical scheme fees tax credit, and that would give us 13,104 Rand. So there was no excess contributions and there were no qualifying expenses, so they wouldn't qualify for an additional medical expense tax credit. So then our tax payable on our normal tax income, excluding the lump sum, would be 72,759. Then the tax payable on the tax portion of our lump sum. Now this part we will use our tax, our retirement fund tax table. And we would then take our 1.4 million less as per the table 1,155,000, multiply that by 36% plus the 143,550 Rand, and that would give us 259,875. So that plus our normal tax payable on taxable income of the 72,759 will give us a total tax payable of 332,634 Rand for the year. So then Mike will have to pay over to SARS the 332,634 Rand.
Can I ask, because the employee was employed 11 months during the year, but on calculation of medical scheme fee tax credit, you counted for 12 months.
Okay. Yes, you're correct. You're so right. Okay. Let's work on the assumption that he still continued contributing to his medical tax to his medical aid after his his retirement. I will just make that a bit clearer. I think in the questions that you'll get, it would be a bit clearer to understand that he was still contributing to his medical aid after he went on retirement.
I would like to just get some clarity on which formula to use when calculating the taxable income for the retirement lump sum for public sector employees. If the employee in question started working after 1 March 1998, we don't use the A equals B over C times D? Confirm?
Yes.
All right, thank you.
Awesome. Anyone else?
But generally, tax is quite tricky for me. For example, the first question that was asking on the question that you asked us, I think it was the first question that you were asking about which scenario doesn't have that cannot be allowed to be deducted. I was writing it down. I have just lost track of it. I don't know, the way the questions are asked are kind of confusing. I think at the time we were at the time, I think another colleague chose question no, answer C as the answer on that question. I think the way the questions are asked can be a bit vague, or maybe it's just that we are not yet tax gurus. That's why we get a bit confused.
Okay. I think it's just a matter of when you understand the concepts, then it gets a bit easier for you to answer. Is it this one?
Yes, that one.
Okay.
How it mentions that when determining the taxable retirement benefit, the following will not be allowed as a deduction. It was easy to choose C because in our head, we were just thinking this person is transferring money from one company to another. So we are not going to include this one. And yet you are actually asking which one is not allowed. I don't know how to put it, but it can be quite vague, or it's just me who is not yet who has not yet really grasped the concepts, I guess.
I think most people actually have the same feeling that you do. It's just that they're not willing to voice it out. So it's just a matter of reading carefully, number one, when we are in the exam. I know that's very difficult, especially when you're looking at the time and you are feeling pressured. So it's always important to try and read to understand what you're being asked, and then take the knowledge that you have and apply it to the scenario at hand. It's just one word or one simple thing that seems like, oh, okay, this is what they're trying to say, but in actual fact, they're saying something totally different, and you've missed the question and you've lost out on the marks. So when we are going through the material, we shouldn't just read quickly just because we want to get through it. We need to understand the concept.
Yes, yeah. And then now I'm thinking, no, man.
Someone is speaking there. Hi.
Somebody was muted, was talking. I've just muted.
Okay.
After
awesome.
There's another hand that is up. Ne?
Okay.
Over to you after explain Mapoka.
Okay, awesome. So when we are reading the questions, that's why we always start with the required, so that we can already start picturing what is it that we need to answer when we go through the background or the information that is applicable for the question. So we always start with our required so that we can understand what is it that we need to go and look for when we are reading, and then start making mental notes of, oh yes, this is what I studied, this is what I remember the concept being about, so that when we start answering, we already know that we are answering what direction we're taking in our answer. Okay.
Thank you.
All right.
Yes, ma'am. So I would like to know about long service reward. So I know that you at 5,000, right? But I've seen a question where they said the employer gave the employee 12,153. So then the answers there, they deducted 5,000. But I've also seen an answer where they did not deduct, they just put that long service reward as it is. So I'm confused which one should we put in, the 12,000 as it is, or the 12,000 minus 5,000.
Okay, so you need to look at what exactly the reward was. And we cannot just say because I don't know the other question that you are referring to, ne? I can't speak to it. But in our situation, the person received money, right? Sometimes they would have given the person a laptop or whatever. So it will be depending on what the employer gave to the person. So if that person had received cash, a use of an asset as a fringe benefit, then that cash award would then be exempt. So in this case, we received cash, so we gave that person that allowance or that the exemption, the 5,000 Rand exemption.
Thanks, ma'am. I just wanted to ask, man, I lost the track on that 31, how it was calculated. Could you help me on the example that we're doing?
Okay. Where are you lost? Let me show it again.
Remember, we've got 25 years then and that 31.
Oh, okay. So we only work on the full years that the person worked. So if the person started working in 1992 March, ne? The number of years would have been, the full years would have been 93, 4, 5, 6, 7, 8, 9, 10, which is 2000, and then all the way down to 2023. That will then give us, the full years would be 31 years. And then, excuse me, then there would be 11 months that are left over. So the full number of years would be the 31, ignoring the 11 months.
Okay, then I'm fine with that one. Then okay. 25 years, how did we get 25 years? Because I was lost on those ones.
Awesome. Okay. So also counting from 19, remember if you are, if they were employed from the first, sorry, let me say it like this. So now we are counting from the 1st of March, 1998, all the way till the full year of service, which would have been 2023. So from 2023, counting backwards to 98 would give us the 25 years.
Okay, thanks, sir.
Okay, awesome. Mapuka, sorry. I quickly went to the question that you're referring to, ne? I had it open somewhere in the background. You were saying that the long service award was the 12,153.
Yes.
And then you're saying that if you look at the solution, they did minus it from the, they did minus 5,000 Rand from it.
Yes. So my point was, I've seen a question whereby they did not deduct the 5,000. So I wanted clarity that as to which one is correct, the one that we deduct 5,000 or the one that we don't deduct.
Okay, but I get we're going to look at how long the person has been employed, ne? So there are conditions or there are criteria that the person must first meet before they can actually be rewarded or get that exemption. So if the person gets cash or they got an asset, whatever that value would be, let's say in our case, we had the 10,000 Rand, and the person has worked for a period of an initial period of 15 years, which was unbroken, or any subsequent 10-year period, then that person would then qualify for the 5,000 Rand exemption. But if, let's say, they didn't work that period, that criteria hasn't been met, then they wouldn't have qualified for that exemption. So anything exceeding that 5,000 because of the number of years, also looking at the number of years that the person has been in service, then you would then give them that exemption. But if, let's say, I've been working for my company for 5 years and they gave me a long service award for those 5 years, I wouldn't qualify for the exemption of the 5,000 Rand.
Okay, okay, okay.
Okay, so we need to go back and look at what are the long service award conditions so that we can see if that person will qualify for the exemption or not.
Okay, thank you.
Okay.
Anisha, I think wanted to say something.
Yes, please to speak.
Anisa,
Don't be shy.
and then somebody wrote on the chat Funzani. Please speak up.
No, I'm fine. Thanks.
Don't be shy. Speak to us.
No, honestly, I'm fine.
What did you want to clarify?
You mean me?
Yes.
No. I think it was what I can't remember if it was Manoa who was speaking. I can't remember who was asking the question about the 5,000. Because I think what that person wanted, I think she just wanted clarity on the, I think the requirements or the criteria for different scenarios. Yes, I think she
so
that's
now
what
we know that on Saturday we will cover some long service so that Mapuka will get comfortable with it, ne?
To help us too.
Yeah, definitely. Because she's the one who spoke up, we will definitely cover it just for her as well and everybody else as well.
Funzani wrote, can we do taxation of trust and donation tax?
Okay.
My clarity is on referencing the section because now the lecturers are too hard to answer because they say we have to reference the sum section when you're writing test or exam. Is it possible on your side to when you are preparing some questions and then include the section reference, like e.g. when gift from colleagues, then support that statement by section.
Okay, I can definitely do that.
Because now the lectures are too hard to us.
They're not being too hard. Listen, that's the only way you will remember. It's for your own benefit. When you are doing this on a day-to-day basis, then you remember easily where you'll find that information. So it's for your own benefit as well.
Okay, thank you.
Hi, can we discuss right of use of MV and rental income as well? So maybe it's in addition to what you have to prepare.
Can we look at the one about severance benefits? Are you guys okay with going through questions 12.6 in the practice pack? So we'll go through question 12.6, and we are required to calculate Martha's income tax liability in respect of the severance benefit and pension fund lump sum benefit that she received during the 2024 year of assessment. So Martha received a severance benefit amounting to 90,000 Rand from her employer on the 31st of December 2023. She had previously received a retirement annuity lump sum amounting to 520,000 Rand during the 2021 year of assessment. Okay. Let's read the full thing and then we'll go through it step by step. And then Martha retired on the 31st of January 2024 at the age of 65. On that date, she received a retirement lump sum benefit amounting to 500,000 Rand from her pension fund. She transferred 100,000 Rand of this amount to another approved pension preservation fund. Martha had pension fund contributions amounting to 3,000 Rand disallowed during in the current year of assessment. Furthermore, on the 28th of February 2023, she had a balance of disallowed pension fund contributions with respect to previous years of assessment amounting to 7,000 Rand. Okay, awesome. So we will take it from the severance benefit amounting to 90,000 Rand from her employer on the 31st of December 2023. How would we then treat that amount. What do you guys say?
I think we add it to taxable income.
And then what do we then also do with the 520,000 rand that she had received during the 2021 year of assessment?
I think you were going to include it too.
Okay. Why? You were the one who was telling me about sections.
Yes, I'm the
one. Tell me, why do you say that? Remember, we spoke earlier on about our lump sum benefits being taxed on a cumulative basis, right? So whatever, yes. So going back to that concept. So if I got an amount in 2021, now when I get another amount in 2023, I must still take that into consideration. I don't ignore the amounts that I received previously. So what tax table are we going to be using for this 90,000 plus the 520,000 rand? Do we use withdrawal or do we use the retirement table? Retirement statement.
We use the retirement one.
Yes. So using that concept, we would take the 520,000 rand plus the 90,000 rand, which would then give us 610,000 rand. And then to calculate the tax, we would then go to the tax table, which would then we would be in the first line, which tells us that we take the 610,000 minus 550,000 rand multiplied by 18%. That gives us a tax amount of 10,800 rand. Then do we then give what's her name, Martha, notional tax on this 520,000 rand? And if so, what do we use? What tax table do you use? Remember we said they're giving up on me. The notional tax would then be calculated using the severance benefit or the retirement death and retrenchment tax table. So this 520,000 rand, we would fall in the first line. So there wouldn't be any notional tax that we allow because 520,000 is less than the 550,000 rand according to the tax table. So that would be a negative amount. So it can never be a negative amount. We could never have a negative tax amount. So that then means that our notional tax on the 520,000 would be 0. So the tax that would be payable on the severance benefit would be the 10,800 rand. So let's calculate the tax on the pension. So on the 31st of January 2024, she retired at the age of 65. And on that date, she received a retirement lump sum benefit of 500,000 rand. Okay. So, and then they tell us that she also transferred 100,000 rand. So we know that the transfer between the pension funds would be allowed as a deduction for her. And then they tell us that she had contributions of 3,000 rand that were disallowed during the current year of assessment. So that would also be allowed as a deduction against the lump sum that she got. And then they also tell us that from previous years, she had an amount of 7,000 rand, which was also disallowed. So she can also deduct that against her lump sum. So then that would give us an amount of, let's take the 500,000 minus 100. That gives us an amount of 390,000 rand as our taxable portion of the pension fund lump sum. So then the taxable amount would be the 390,000 rand that relates to the pension that she got on the 31st of January 2024, plus the 90,000 Rand severance benefit plus the 520,000 Rand, going back to that cumulative basis principle that we spoke about. So that gives us a taxable amount of 1 million Rand. So then to calculate the tax, we go to our tax table, the retirement tax table, and we'll take the 1 million minus 770,000 Rand as per the table, multiplied by 27%, plus 39,600 Rand, and that will give us 101,700 Rand. Then we will also go back and work out the notional tax on the 520 plus the 90,000, which would give us the 610,000, and that will be the 10,800 that we already calculated earlier on, because we're using the same tax table, so there wouldn't be a difference in this case. Then the amount that will be taxed on the pension fund lump sum would then be 90,900 Rand. So then the total tax that would have been payable for the severance benefit as well as the retirement lump sum would be the 101,700 Rand.
I think I got lost as to, firstly, why did we add the 520,000 to the severance benefit? Secondly, why are we calculating them separately when the year of assessment is the same year?
Because it's two different things.
Sorry?
It's two different things. Remember, they asked you for, look at the question. The question says, in respect of the severance benefit and the pension fund lump sum benefit, okay? So even though everything happened in the same year, there are two separate things that took place. First, you received the severance benefit on the 31st of December. Then you received your pension on the 31st of January. When that event happened on the 31st of December, they would have taxed you on that amount when you got it in December. Then again, when you got the amount on the 31st of January, you would have been taxed again on that event that took place on the 31st of January. So it's two different events that takes place during the same year of assessment. You get taxed when the event happens.
Okay, so so when she receives her pension on 31 January 2024, do we put into consideration again the 520,000?
Yes. So remember when we started, when we had our true and false session there in the beginning, we spoke about we tax our lump sum benefits on a cumulative basis.
Yes.
So what does that mean? Cumulative, that means every time we accumulate, everything that we accumulate, we will then include it as part of our calculation. So if I resign from my job in 2013, I got a withdrawal benefit at that point and of 520,000 Rand, for instance. Then again, when I got a severance benefit on the 31st of December 2023. Then again, as another event happened on the 31st of January 2024. All those amounts that I've been receiving, we need to take those into consideration. We cannot treat them, we cannot ignore them. We need to take them forward every single time. You need to include them as part of your lump sum benefit.
All right, thank you.
So and that's then, what, yeah.
And then what do they mean by if an amount is disallowed in the current year of assessment?
So that means the contributions that Martha made during the year either exceeded that limit that would have been the 300,000, more than the 300,000, or the 27 point something percent, or the taxable her taxable income for the year. So that means she exceeded her contributions or the allowable contributions by the 3,000 Rand. So she wasn't able to claim that as a deduction in terms of Section 11 Cap F for this year of assessment. Yeah.
And Dineo, just on what Manoa was saying on that disallowed. Like it means that if it's disallowed, say in the previous year of assessment, we are then allowed to deduct it in the following year of assessment, right?
Yes.
Because this question, I think I just crammed it. I didn't understand it, but now.
Listen, you mustn't cram the questions because the question will come out differently in the assessments. So you always need to understand what you're doing. So if, let's say, in Martha's case, from the other years, so clearly she's actually contributing much more than what she could deduct as part of her Section 11 Cap F deductions. So in the previous years, she still had an amount of 7,000 that was carried over. And then this current year, again, there was an additional 3,000 Rand that she couldn't claim. So then she can claim them once she goes on retirement against her retirement lump sum benefit.
Oh, so it means in this specific one, okay, the 7,000 is from the previous year of assessment. That's what can be deducted in this current one. And then the 3,000, we won't deduct it now. It will only be deducted in the next year of assessment.
No, no, wait. What are you referring to?
Okay, no, Martha had a pension fund contribution amounting to 3,000 disallowed in the current year of assessment. So because it's in the current year of assessment, we won't deduct it, right?
We will deduct it. So remember, when she goes on retirement, now she's getting the money from the contributions that she's making every month.
Yes.
So does it seem fair to you that I now get taxed on the amount that I was not allowed to deduct?
Okay.
No.
Makes sense.
Yeah, okay, yeah.
So because she wasn't allowed to deduct it, but she's being taxed on that full 500,000, including the 3,000 and the 7,000 that she actually contributed. So she didn't get that benefit. So now when she gets the money, they must give her that deduction.
Oh, okay. So if the scenario was different and Martha was not resigning.
But retiring.
Retiring. I mean, yes, she was not retiring. It would we treat it differently? Say Martha was not retiring. You know, Martha is still working.
Yes, she's still working, and now she's getting now she's gonna be getting a withdrawal benefit. That's what you're talking about, right?
Yes.
Okay. My brain just froze for 2 seconds. I want to think now.
I was always with text.
So let's go back to our what we are allowed to deduct when we have the calculation. So when we have our calculation, we are allowed to deduct our transfers. We are allowed to deduct the amounts that we're not allowed as contributions. So again, it's the same concept. If now I'm being taxed on the amount and I wasn't allowed to claim that deduction, would it be fair for me to be taxed on the full amount?
No.
Yeah. So let's think about it logically, inverted commas. Would it be fair for me to be taxed on the amount even though I didn't get the benefit?
No.
Yeah. So that is I want to say the easiest way for me to rationalize it with you so that you can remember it in future.
Yeah, no, I'll ask myself the same question.
So you'll be asking, you can keep asking yourself, is it fair that I get taxed on this even though I didn't receive the benefit.
Yeah, no, thanks.
Okay, awesome.
So if none of the three conditions of severance benefits are met, are we only going to do the lump sum calculation only?
Which lump sum? The pension or?
Yeah, if like we have like if we given the one for pension, are we only going to do that one only? Because I get it, we have to check if like the employee meets one of the three conditions severance benefits. So if all of them are not met, what are we going to do? Are we only going to do the lump sum calculation only?
So then the severance benefit is not going to be taxed using the retirement tax table. So you go back to your normal gross income rules or the normal tax table. So you would use the one that everybody gets taxed on, the normal table. You would work out the tax as per the more expensive tax table, the one that ends on 45%.
Okay, thank you.
Okay, awesome.
I wanted to ask what is notional tax?
Okay, the notional tax. Okay, awesome. So the notional tax is, how do I say this in a simple term? So we are saying to you, okay, we are gonna give you a tax benefit and this because you would have paid some portion or you would have paid tax on this lump sum already. But we're not going to allow you that full amount because in this instance, the 520,000 Rand would have been, for instance, would have been calculated using the withdrawal tax table. Ne? So we're saying now, we're going to give you the benefit, but we're going to use the table. The one that we're using now would be the retirement tax table. You're not going to use the withdrawal tax table because we're allowing you to have some sort of deduction, even though it's not really what you actually incurred as the tax. It's not what you really paid, but we're going to give you some sort of incentive because we deem that you actually did pay tax on the transaction. So in our example, the 520,000, when we are working it out for the severance benefit, we actually didn't have a notional tax for them because it was less than the 550,000. So we can never have a negative tax amount. So we didn't give them any notional tax. But then when we were working out our pension fund lump sum tax portion, we could give them the 10,000 Rand because the 610,000, which is the 520 plus the 90,000, we work out the tax on that using the retirement table now. And that would give us the 10,000 and some change. So that gave us an amount that we deemed to be your tax that you would have paid on that thing. Yes, in this case, the amount is exactly the same as what they actually paid, but it won't always be the case. So it's like we are estimating that you would have paid this amount of tax had it been that this was a retirement or had it been that this was a severance benefit.
Noted, thank you.
Okay, awesome. And let's look at this one. Calculate Mickey's tax liability for the year of assessment ended 29 February 2024. The scenario, Mickey Mouse retired from Cartoon Limited on 31 December 2023 at the age of 66 years. Mickey is married out of community of property. His children are all over the age of 18 years. Mickey provides you with the following information. Salary received from Cartoon Limited was 17,000 Rand per month. Entertainment allowance, he did not incur any costs of 1,100 Rand. The bonus received on the 31st of July 2023 was 17,000 Rand. Free medical aid, the company contributes 2,100 per month. And then Mickey's wife is the only registered dependent on the medical aid. After his retirement, Mickey left the medical aid. Okay, awesome. So in this question, they make it clear to us that they don't continue to pay their medical aid after he's retired. Okay, cool beans. So that goes back to our medical tax credits as well when we are doing the calculation. So then they tell us after his retirement, Mickey still performed occasional services for Cartoon Limited. He received 13,000 in total for these services during the current year of assessment. Okay, Mickey received a lump sum of 846,500 Rand from the pension fund on retirement date and a monthly pension of 6,800 Rand. Mickey did not receive any other payments from any pension or other funds. On the 28th of February 2023, there was a balance of contributions amounting to 290,670 that had not been allowed as a deduction, as a tax deduction. Mickey used 550,000 of his lump sum to purchase a 10-year annuity from Sanlam. He will receive a monthly annuity of 6,250 for 10 years. The term of the annuity commenced on the 1st of January 2024. Mickey received the following income from investments during the current year of assessment: gross interest from local banks, which is not a tax-free investment, of 35,900, gross dividends from local listed companies of 25,000 Rand, gross dividends from foreign units trust of 4,280 Rand, and then they tell us Mickey made pension fund contributions up to the date of his retirement of 3,660 Rand per month. Okay, awesome. So we need to calculate until he retired on the 31st of December 2023. So he worked from the 1st of March until 31st December. So that is 10 months. Okay. So his salary of 17,000 Rand per month, we will multiply that by 10 months because it is from the 1st of March until the 31st of December 2023. So that would give us 170,000 Rand that must be included as part of his gross income. And then the entertainment allowance, which is a monthly amount, will be the 1,100 Rand multiplied by 10. So that would be 11,000 that must be included monthly. Then he received a bonus of 17,000 Rand. That's a once-off amount, so that will be included as well. Then he has a fringe benefit for the medical aid of 2,100 Rand per month. So, and then they tell us that after he retired, he left the medical aid. So that means our contributions will run from March until December. So that's for 10 months. So it's the 2,100 multiplied by 10. That gives us 21,000 Rand per month. Then he still had occasional services that he performed for the company. For the full year, he received a total of 13,000 Rand, which would also form part of his gross income for services rendered. Okay, and then from there, they tell us that he received the lump sum. Okay, the lump sum we'll deal with separately. Then they tell us that he had a monthly pension of 6,800 Rand. And we know he worked until the 31st of December. So January and February, that's when he would have received the pension, the monthly pension of 6,800. So we would multiply that by 2 months. And that would give us 13,600 Rand. Then they tell us that he did not receive any other payments from any pension. The contributions we'll deal with a little bit later. Then they tell us that he went and made a contribution of 550,000 of his lump sum to purchase a 10-year annuity from Sanlam, and there he would receive 6,250 Rand for 10 years. Then they tell us that it started from the 1st of January 2024. So with this one, we would need to first work out the capital. Well, we would have to work out the amount that would be included would be the 6,250 multiplied by 2 months, then less the capital portion, where we would use the formula A over B multiplied by C. A being our the amount that we purchased the annuity for, and then B would be our monthly contribution multiplied by the period that the annuity will run for. So that would be the 6,650 multiplied by 12 months for the period of 10 years, because it's a monthly annuity, and then multiplied by the portion that he received for this year, which would be the 12,500. So that would give us, the capital portion would then be 9,167. So that would be then deducted from the 12,500 Rand. That gives us an amount of, let's see, that gives us an amount of, I'm trying to do the math. Okay, it's 3,333 Rand that will be included as part of his his gross income for the year. And then from there, we received interest from local banks. So we would include it, and then we would then exclude our exemption of 34,500 for the year. So only 1,400 would then be taxed. Then they tell us that we also received a dividends from a local listed company. So we know that our dividends is exempt in full. So we would include the 25,000 Rand, then we would exempt it. So 0 would be included as part of our gross income. Then with regards to our foreign dividends, we would include the 4,280 Rand, but then we have an exemption with the foreign unit trusts. We know that we use the 25 over 45 multiplied by the 4,280 to determine what our exemption would be. And in this case, the exemption would be 2,378. So we would only include 1,902 Rand from that. And that gives us a total taxable income of 252 and 52,235 Rand. Okay, so that's the gross income.
Just a quick one. I know
Yes, there's a lot.
Back to the after his retirement, Mickey still performed occasional services, right?
Yes.
And he received 13,000, and it says a current year of assessment. Because he resigned in December, for the current year of assessment would it be the 2 months, the 13,000 times 2, that will be included.
No, but remember they tell us that this is the total. In total, that's what he got.
Oh, yes, in total.
In total. So it's that reading is a skill thing that we all get wrong. Don't worry, I
Yes.
also get it wrong. So if they had said it was per month, then we would have multiplied it by 2. But because they told us that it's the total amount that he received during the year of assessment for the services rendered, then we would only include the 13,000 rand.
Okay, got it.
Okay, awesome. Cool beans. Okay, so now that's our taxable, that's the income partner. Then now we must go and calculate the deductions.
I wanted to ask on the monthly salary. Do we use that do we add that on the taxable income? And yet usually monthly salaries we pay per year on them. Do we include them on the taxable income?
Yes, we do. So what normally happens, what happens is that every month your employer will withhold the pay as you earn, right? But at the end of the year, when you must go and declare to SARS what you actually received during the year of assessment, you need to give them a full detail of everything that you got. So that will include your monthly salary. Then they will calculate the tax payable on the full amounts that you received during the year. And then you would then deduct, after you've calculated the tax payable, you will then deduct the pay as you earn from the tax payable for the year. So that pay as you earn is actually a credit towards your tax payable for the full year of assessment. Excuse me. So it will help reduce the amount that you need to pay to SARS. So for most people, they don't have to pay anything in because their employer has withheld that money during the year of assessment. So then we need to work out the deductions. In this case, we would have our contributions, which is at 0.6, the 3,660 Rand per month. So we calculated for the 10 months, and our contributions for the full year was the 36,000, would be 36,600 Rand. Then they tell us that we had an amount of 290,670 that was not allowed as a deduction from previous years. So that would also be included as part of our, that would not, let's see. Okay. So the total amount would then, we would not include that now. We would include that as part of our deductions against our lump sum that we got for the year, which would be the 846,500 Rand. So we will only calculate the deduction against the 36,600 Rand. And then our limit would be the 27.5% multiplied by either our taxable income or our remuneration, whichever one is the lesser of the two. Our taxable income was 252,235 Rand. And then our remuneration would be our salary plus the entertainment allowance that we received, plus the fringe benefit, and then also plus the pension amount that we received, as well as the pension, the annuity that we purchased during the year of assessment of 3,333. That gives us an amount of, let's see here, the 27.5% would be 64,882 rand. And then, so the limit would be between 350,000 or 69,365 or 252,235 rand. So our limit is whichever one of the lesser, it would be the 69,365. Therefore, our actual contribution or deduction that we can claim is the 36,600 rand. So our taxable income for the year would be 215,635 rand. So calculating the taxable portion of our lump sum, which is the 846,500, we would then minus the past pension fund contributions that were previously not allowed as deductions, which would be the 290,670 rand. And that gives us an amount of 555,830 rand. So that will be our taxable portion of the lump sum. Then now to calculate the normal tax on the taxable income, excluding the lump sum, we would take the 215,000 that we calculated, 215,635 multiplied by 18%, and that gives us 38,814. Less our rebates, she will get the primary, she'll get the primary rebate and secondary rebate because she's older than, or he's older than 65. And then that's 26,679. And then medical scheme fees tax credit, because there's two people on the medical aid, himself and his wife, they would get this 364 rand multiplied by the 10 months, because we know that they said that they're going to stop contributing after he leaves for retirement. And then additional qualifying expenses, we will take the 21,000 rand that was contributed, which is the 2,100 multiplied by 10. And then we will less the three times of the 364 times 2 times 10, which will give us 21,840. So it's more. So there wouldn't be any excess medical aid contributions credit in that case. So that multiplied by 33.3% will give us 0. So there wouldn't be an additional qualifying medical expense tax credit. Then, so then our net normal tax payable on the normal taxable income would then be the 38,000, which we got from our tax table calculation, less our rebate of 26,679, less our additional qualifying medical, our medical scheme fees tax credit of 7,280. And that gives us a net normal tax of 4,855. Then the tax payable on the taxable portion of the lump sum will be the 555,830 less the 550,000 as per the table, multiplied by 18%, and that gives us 1,049 rand. So the total tax payable for the year would be 5,904 rand. That's it from my side.
Thank you, Dineo.
Thank you, ladies and gentlemen.